Hey everybody, this is Jose Blasco here. We are about to get started. This is a sound check. Please go ahead and confirm that you hear me well so we can start. We got less than a minute and we begin. So quick message on the chat box, that would be very much appreciated as always. Thank you so much. Almost time to get started again. Very good. Everybody, thank you for that. Thank you for those messages. I'll put myself here as always on the little corner on the screen. How are you, Joanne, Mario, Christian? How are you, everybody? Just looking at the various streams. Everything under control. We are good to go. Here we go. Time to get started. Welcome to the session, everyone. Today is Aug-4, 2021. This is Options with Options. My name is Jose Blasco. The disclaimer is being highlighted on the screen. Please read it carefully. This is important information. Read it completely. I'm counting on you to do that. Because we are about to begin our trading session, and trading obviously carries financial risk. So the reason for those disclaimers are obviously important. It's relevant stuff. The structure for the session, as always, we'll be looking at the current market environment, understand what's happening out there. From there, look at trades that we may have in our accounts running. If any, we'll talk about what to do with those trades. We call that trade management. What do we do during the life of a trade? And then most importantly, we'll try to put as much time as possible into identifying new opportunities, plan them, identify and set all those parameters and execute them. So you can also practice using either paper money or real money, or either larger size or smaller size. Those, of course, are your decision. But the parameters and how I got to those trading opportunities, certainly it's something that I will cover with great level of detail, so you guys can practice and practice and practice many other days, even when we are not running a session live. Because one thing is to have knowledge, different story is to have developed a proper skill, and that implies practice, isn't it? Very good. Okay, so I see everybody is ready based on the chat box and so on. So let's begin our analysis. Let me move here into the 55 minute time frame for the S&P. Here we go. So what do we have? Okay, well, on the left, we have a daily time frame of the S&P. If we were to look at the climate, we just switched from a little bit of a scary dot, right? Going from many blues to one single red and back to blue. Okay. So we just started a new climate. 1 out of 7 is what statistics suggest. So we are set for some movement to the upside, especially when you look at the difference between implied volatility for calls and puts. We can see that it's not too much greater, if you wish, but there is a little bit of a difference that is in the favor of the calls versus the puts. The blue color is the calls, the gray color is the puts. You can see 1233 versus 12, and therefore this is suggesting that from behind the scenes, and if you recall from prior sessions, this is a 3-day average of the implied volatility. So as an average, okay, during the last 3 days, behind the scenes, there is some building up of a bullish sentiment that we can read from the options markets. Okay, if we were to look at what's happening right now, to be honest, we don't have a clearer indication of anything if you were to look at what's happening right now at this time, real time, because the front week is showing 1.1 time more puts than calls, next one 1.1 time more puts than calls, the next one 1.2 times more calls than puts. Really, it's nothing is too significant to mean much. Then here you are above average, but you are also above average with the puts. So again, it's not saying so much. And to be honest, when you look at the candle shape, the daily candle shape, it's kind of like a doji type of candle, which is indeed representing a little bit of indecision, where price is actually trading exactly where the EMA is, right? Which is an average price, and it could be a great reason for many people to be buying at an average price. Also, many people selling at an average price. So at this moment in time, there is a great level of indecision in the market, but the climate is up. We got a little bit of building up on the call side. So definitely, if we have any bet on the S&P, the bet would be is gonna go higher, isn't it? Now, what is happening on the implied volatility for those options, the VIX? Okay, how are you, Wayne? Good to see you, my friend. Good to see you. So, what's happening with the implied volatility for options? Okay, I'm talking about the VIX. Well, the VIX is currently trading 2% higher than yesterday. That's a tiny move. It's trading at 18.40. So again, not very clear what may happen because yeah, indeed we are closer to a green UFO than a red UFO, but realistically the red UFO is very far. So to reach that red UFO, it would require a pretty powerful drop in the market, which again, we just said the climate is up. So what's more likely is that volatility will drop a bit and then maybe stay stagnant like here just for a little bit, and then we'll see if it goes higher or lower. It also depends on how it goes down, because as it's going down, we may have sell-on field orders added, and we get to see a red UFO. So right now, really, the implied volatility at this moment in time in a scenario like this, it's not too relevant in the sense that it doesn't mean too much, if you wish. It's not too useful. So again, it all depends on what you have on your portfolio. If your account had no trades, then of course you want to execute trades based on your trade plan. Whatever trade you find, take it, because you got nothing in the account. But if your account already has certain trades, okay, we always talk about portfolio management, where if you have already multiple trades while you're long, then adding some shorts for a hedge would be a good idea. Well, the same concept apply when it comes to implied volatility. If you are already long Vega instead of long Delta, right? So you may want to add some short Vega, or vice versa. If you are already short Vega, you may want to add some long Vega, okay? How are you, Siderman? How are you, Clive? Clive, by the way, I owe you an email. I noticed your email, I believe it was yesterday, and then I'm like, okay, I'm going to respond, and then I forgot. So please bear with me. I got distracted, but I will get back to you, Clive, okay? So just know that I read you. So anyway, yeah, again, as I was saying, again, when implied volatility is in a position like that, really, there's no preference. It's more about what else do you have in your account, and therefore what else do you need to offset, to hedge, to balance out the various great characteristics of your portfolio. That's what really it is. Okay, so in other words, today we're gonna continue with what we have been doing since the prior weeks, looking to put together directional trades. So we're gonna do that, but also know that. And I just lost my chain of thought. I wanted to share 2 or 3 things at the same time, and I just lost it. What I was going to say. Yeah, okay, I know. We're gonna go take a look at one of the trades that at least I know Siderman has it. Okay, which is the one with SKT. So we're gonna look at that one, and then from there we'll start putting new trades together, following the steps of what we have been doing in the prior weeks. Okay, so time for me to move to TradeStation, where we had a note here with to be reviewed, okay, with SKT, and let's take a look at what's happening to that particular stock, because that stock, if you recall, was let me see, study. That stock, oh, you know what, I think I had it saved already. That stock was about to report earnings, we saw last week, if I'm not mistaken, or maybe I am mistaken. Okay, EPS postings. Okay, so for whatever reason, it's not taking it. Okay, so it's giving an error message here. So what's the error message? Invalid fundamental field. Okay, interesting. So that, I guess, it's an error in TradeStation. So you know what? Let's look at earnings with top. So SKT. So let's get the market data on screen, and for SKT, you can see earnings took place on August 3, which that was yesterday, right? And again, when earnings take place, many things could happen, okay? And normally, you expect some sort of a move, especially if the result is a little bit of a surprise. It does seem like the estimated and the reported was quite different. Instead of 0.21, it was 0.02. Okay, so the difference was pretty big, but maybe someone knew something because yeah, while you had a little bit of a spike of volatility there, up and down, really the stock didn't do anything that magical either. It's kind of trading around that $17 mark where it was trading the days before. So yeah, so this is not looking good for the ones of you that you are in this trade, because for you to profit, that stock needs to rally and go above 21. After proving to us that this stock was not was not moving in our direction, we expected it to go higher from here, and instead it went down and down and down. So after proving that it was not going to be our ally, now the hope last week, if you wish, was okay, earnings may totally change the trend and push it up. But we can see that it seems that is not the case at all. Okay, so probably this trade, I mean, there is nothing else to be done, to be honest. Okay, this trade has an expiration date that was really approaching now. If I'm not mistaken, it was at the end of this week. I think that was the case. Let me load Option Station Pro so we can see it. And again, when you have a situation like that, so the best you could have done is to mitigate the problem by doing what we've done, which was converting a horizontal into a vertical spread with different strikes. And basically we reduced the risk of the trade from, I believe it was $67 to $57. So we manage a little bit the risk reduction, but there is not much more we can do. Oh, okay, wait a minute. It's until August 20. I thought it was until next Friday. Okay, so, well, again, it's quite unlikely. I mean, if you look at one standard deviation, it would say that was normal, okay, is for the stock to reach, this gray zone, which is 18.5. So we need it to be above 21 to be hitting that, nice profit mark. So, again, this trade is indeed not looking good, but at the same time, we did the right thing. We manage it the right way, and therefore now it's just about leaving it alone and see what happens, which again is probably going to be a $57 loss per contract. Okay, cool. Okay, so this is all we had in the account, and therefore now I am switching. I'm looking at the multiple chats in case there are questions. You guys feel free to say hi as well, and not to be shy, no matter if you are in YouTube or in LinkedIn, or you are in Twitch or Facebook or wherever you are. Just say hi, okay, guys, and that way we are a bit better connected. It's nice for me to see those highs. Okay, so don't be shy. But anyway, so we're gonna continue now with looking at market opportunities, and I have multiple news that I'm very excited to share, actually, because as I've been building up new tools and new processes that we are adding to our methods to increase the quality of our trades. Together with those steps and those methods, we are actually programming and developing more and more automation, if you wish, to help us save plenty of time. Thanks to the use of top when it comes to finding trades and executing trades. Okay, so be ready, because I'm going to show a collection of new things today, and that's going to be powerful stuff. Okay, so I'm getting here into the matrix. Okay, this is nothing new. Let me float it. So here's the matrix. We've seen the matrix before. The one thing that is new is that now we have an auto climate tab that was not there before. Okay, you didn't see that before, isn't it? So now it's there, and therefore we can start doing a series of things that are quite smart. Okay, and by the way, the things I'm going to show you in the end can be done in various ways depending on your particular trading plans. I am assuming that all of you have a trading plan or are working on a trading plan, or maybe if you're newer to trading, you may not have it, but you need to have it before you get trading seriously, because no plan is a problem, right? So in other words, my plan or my way on how to trade, it's quite perfectionist, and the price to pay to be very perfectionist is it take a bit longer to find trades, or you find a bit less trades that if you were to be more tolerant and take anything that looks like a trade. So I prefer not to be that tolerant and be more demanding to the trades. And therefore, when I lead you into the trades during the sessions, when we plan trades together and so on, you have seen me many times go through setups and be like, no. And I said many times in the past, the job of a trader is to say no more often than to accept a trade, right? So you should say no more often than saying yes. This is the sign of a trader who is fine-tuning, who is demanding, who is picky, who is looking for quality instead of quantity, right? So we want to continue doing that. And I will continue be that perfectionist. But the beauty is that now we're going to find trades every time, okay? Or almost every time. Why? Because I'm going to have multiple ways on how to be perfectionist, and because the scanning is taking place real time. So it's going to take no time to go from one perfectionist setup to another perfectionist setup to another perfectionist setup. And guess what? It will be very unlikely that all setups in the end are a no, right? So typically we're gonna find trades. Okay, so let's begin with a quick summary of some of the things that you know, and let's get dive deep into this, fairly quickly. So first of all, on the top of the scan, I selected from advanced option scan, I selected top positive CIV spread. What does that mean? That means that the stocks that are going to be scanned are only stocks where the call prices is greater than the put prices from an implied volatility point of view. There is more implied volatility on the call side than the put side, and we discussed many times that this implies that from behind the scenes there is a bullish sentiment building up from the options markets. Options markets are often traded by professionals, so obviously if the professionals are getting bullish, the individual traders, the home traders, I guess it makes sense to get bullish too, isn't it? So that's one of the first components that we add there. Second component, which we talked about different ways on how to do it, is that, okay, great. I'm willing to accept the fact that the calls are going to be more expensive than the puts. Joanne, I see your message. But I'm willing to accept that. Not only I'm willing to accept that, I want that, but that's a problem because if the calls are more expensive, then my trades are going to be more expensive. Okay, so I want to contain how expensive those trades are going to be, because when I buy options, that sets my risk. The amount of money you pay for an option strategy, if it's debit, okay, the amount of money you pay is the risk. Okay, if the stock goes all the way to zero, something happened and you reach to expiration and the stock never moved, so then what do you lose? You lose the debit paid. In other words, we want to minimize the cost of the trade, okay, but we want the calls to have a little bit of spice versus the puts, so we have this directional bias. So how can we do that? So option number one is to look at put continuous implied volatilities, which are less than the 20% percentile, and therefore that means that options are quite cheap. Okay, that's pretty extreme condition. Another pretty extreme condition is to look at the CIV mean. Okay, so the mean of implied volatility for calls and puts to be below a 2 standard deviation when compared to the historic volatility. Okay, so that's another way to look at implied volatility, or let's call it expensiveness of an options price, which is, maybe the options contract, it's above the 20 percentile, but the speed of movement of the stock is crazy, and therefore it's actually worth it to pay more for the options because the stock is moving like crazy. So then here what we do is that we compare implied volatility and historic volatility to kind of factor in how expensive the options are versus how fast the stock moves. And then we look for an extreme situation being below the 2 standard deviation. Okay, so we're going to start with this one, for example. Okay, and in this case we can see two symbols there. Again, I'll come back to this in a minute. And so that's scan 1 and scan 2 that we always add. Then 34, as you know, is a number I like to start with, but it could be anything really. And then now I'm getting here now, again, reminding you of something important, but very absolutely critical, which is the fact that I am check marking stock strength and group strength, and I am demanding in the long term, okay, in the long term, I am demanding that stock to show an uptrend, but also not only an uptrend, that to show certain level of strength. Okay, because it could be an uptrend, but it's just moving very, very slowly. So it may be an indecision, even though the directional movement is up. So we want to see some impulse to the upside in the longer time frames, both in the stock itself, but also the sector. And that's powerful because we know that stocks depend on their competitors, stocks depend on their groupings, stocks depend on their industries. So having the industry showing that strength is a great help for the stock if the stock was not to move in our direction at the beginning of the trade. Let's say we bought a bit too soon, or things like that. So then the group is likely going to help the stock to, in the end, start moving in the direction we want. Okay, and of course, it's not going to be all the times, but we are trying to add odds in our favor. Also, this is very important for another reason, and I am repeating something I said before, but it's important to keep it in mind. So, we learn through repetition. I hope you don't mind if I repeat certain fundamental or critical things, which is that one of the additions that we added to our sessions as well is the fact that sometimes we'll enter trades without the use of UFOs, which is not the favorite way on how to do it at all. But sometimes you have to get into a trade as soon as possible because you need it as a hedge. Okay, so let's say you have 3 trades long, 2 trades short, and your 2 shorts just hit target, and you're out of the shorts for a profit. So now suddenly you went from a fairly balanced portfolio to a very, very long portfolio, where if the market was going to drop, those stocks will lose a lot of value, and your P&L would be very badly hurt. So you need to enter a short right now. You need it now. You cannot wait for the market to come back to a UFO, things like that, because it's not about you cannot wait. You can always wait. But what I mean by you cannot wait is that you don't know if it's going to happen for sure. So it may not happen. And therefore, you end up with your 3 longs and no hedges against your longs. Okay. So in this sense, again, having the group in your favor allow you to be a bit less precise with the timing. And if you enter too soon in a trade, okay, well, in the end, it may not go too much against you because the grouping is pushing in the other direction, or it may go against you for a while, but then start moving your way because the grouping is pushing indeed, right? So again, this is absolutely critical, and this is not going to be an exception. Especially when it comes to the grouping conditions, we always want the grouping to be in the favor of the stocks. Okay, so keep that in mind. Leland, how are you, my friend? Good to see you. Sergi, very good to see you as well. Very nice to see you guys. So anyway, now what else? Scan list, okay, as you know, of course, we care about the liquidity of our options contracts, and I normally use a penny increment options list that I have. I told you I'm happy to email it to you anytime. So that options list is now imported, and therefore we are filtering out all the stocks in the US based on my list, which provides tradable options that trade in pennies, so you can negotiate well the buying and selling prices, and you can go in the middle of the spreads and try to get a good advantageous entry price. Okay. Then here we got Elliott wave and another type of strength that we will use for non-directional trading. So that will gonna be another day, I guess. And then we got earnings, where when doing directional trades, we always want at least a few days with no earnings in front of us. So I want to exclude stocks that are reporting earnings in less than 5 days. So that way, I don't get in trouble because now, I have no room to reach my target. Okay, that's leaving me with FSLR only, right? What else? Stock price range could be used for multiple applications, but I'm going to skip it. And then now we get into auto climate, which if I uncheck auto climate, so this is going to give you a longer list. In this case, only one more, but it's going to give you a longer list. But in this case, we're going to check it. Okay, and here is where some of my perfectionist approach is going to start. So notice the conditions that we have for auto climate. We have the classical conditions, confirm up and confirm down, and then we have multiple timeframes that we can use. Today, I'm going to use daily and weekly. Okay. Remember the other day I talked about the beauty of 2-day timeframes, 3-day timeframes, etc. So we'll certainly use that, but today I'm just going to focus on daily and weekly. And certainly you can look for confirm up climate on the daily time frame with it could be sensible, it could be hopeful. Of course, you want it to be sensible, but also we have a new condition called early, which is a nice one, meaning that that market is entering a climate, okay, since less than 3 candles ago, okay, 3 candles or less. In other words, if the climate is going to be 7 candles, okay, it's not like this is candle number 6. It's going to be candle number 3 or less. So you are giving yourself the opportunity to enter and benefit from a climate propagating, okay? But what else? I want to increase the probability of the climate to propagate. So what I'm doing is I'm looking at the weekly climate to be up in an early stage, okay? And the daily, I want it to be sensible. And I don't care too much, to be honest, if the climate is a bit exhausted in the daily, because if it's a bit exhausted on the daily, but it's starting on the weekly, so probably that's when you get, many blue dots, and then a few of the red, many blue dots, maybe one red, many blue dots, maybe two or three red, many blue dots, and now of course here there is a big change for SKT that is totally changing direction. But again, if you look at the S&P, I think it's a much clearer example of that, where almost everything is blue, and when you get red is so a very small quantity. And by the way, you know this because of the stats here, even if you don't look at the weekly time frame. But somehow, by filtering out the way I did, which is to look for early climates on the weekly and sensible on the daily, so this is going to give us the opportunity to catch longer lasting moves, which we don't need to be that perfectionist. Okay, you could certainly uncheck everything about the weekly and things like that, and it would still be okay. So I'm going to scan. Okay, and when I do that, I end up with FSLR. Okay, so again, this is the approach. My approach is going to be very perfectionist to end up with very short list, but have multiple combinations ready to go. So as I can vary a few things here, I can vary a few things there. I could vary a few things in different places, and next thing you know, find many more opportunities. Every time I do that, it's going to be a short list. But if I have multiple ways on how to look for setups that are powerful, so in the end, if I was to add up all those symbols, it will be a list which is large enough to find opportunities in a regular basis without having to spend too much time. That's the goal, okay? So we'll start with FSLR, okay? And let's take a look at what's going to happen. I mean, I know already if I look at the daily time frame, the climate is going to be up, okay? Why? Because we filter it for this way, so now we're saving time. We can also see calls are above the puts, right? So calls are above the puts, the climate is up. Even if I look at the weekly, we know the weekly, it's an early climate, it's just started, right? So we got all of this in our favor, okay? And therefore now the goal is, okay, so let's plan the trade in a way where now we find a good entry, okay? Now, notice I started today using a daily climate. I told you the other day about the beauty of the 2-day time frame, the 3-day time frame, and for sure you will see me use that more often than not, okay? But again, to not to distort too much what most of you are used to, because I believe last week maybe I was a bit confusing to some. So, let's start with daily, okay? And we'll add more one step at a time. So what you can see here on the daily is that, all of this is kind of like giving you green light to keep working on a trade plan. So what would you do next? Well, you would get into your charts and look at your probabilities on the 55-minute time frame, which is 50.50, is more than 50%. So finding a UFO is what we need. And now the only thing you will need is that you will need the UFO to line up around 85, which 85 is 85.74. It's somewhere there. And guess what? This is the UFO. So this is our trade. We just need to wait for FSLR to fall. And the moment it falls, you can just take the trade. And here we go. Okay. So now, of course, that looks, at least visually speaking, it looks like it's a pretty important distance. Okay. Pretty important distance. Okay. I mean, we'll talk about it. There is a new tool here as well, max distance, okay? Where you can see, a standard deviation would be 0.84, and the current distance is 171. In other words, that move, it's very exaggerated. So for price to come back to the average, it's going to take a long time, okay? We'll have to talk more about how to use that max distance as well, because there are some applications that could be useful. You can certainly also ignore it, okay? It's not as powerful as the count that we have on the right, which is what you guys are used to, okay? And you can even get into the settings and, disable it. And, max distance now is gone, and then auto climate is what you're used to, okay? But again, I'll check mark it because we will have certain applications to be discussed in future sessions. So anyway, so again, option number one, wait for price to come to this UFO and take the trade. Option number two, what if you need this trade now because you need it for hedging purposes? Okay. Well, if you need this trade now because you need it for hedging purposes, what I discussed the other day, okay, is that another alternative is to look at an 8-minute time frame. Okay, look at an 8-minute time frame, and using this 8-minute time frame. Okay, let me add a few more candles just so we have just a little bit more data on the screen. So, I only got 200 candles. Okay, I'm not sure why I only got 200 candles. Here we go. So now, if you load a bit more data, okay, notice that now we can identify certain possibilities. Okay, so if you recall, what I said is that we're gonna play this from two angles. We are not going to be looking at UFOs on the 8-minute time frame. It's absolutely irrelevant if you are planning to catch a um, weekly slash daily climate. So the 8-minute time frame is too tiny. So we are not going to use UFOs here. What we're going to use is any sort of a breakout type of entry that would allow us to time the trade. So how are we going to do that? Well, first, if you look at those little triangles here on the top, okay, these triangles above are the ones you want to rely on if you were to plan on a breakout. So if price goes above the blue line, okay, if price goes above the blue line, it means that you are breaking a significant pivot high in the context of an up climate, in the context of a stock that belongs to a grouping that is strong, in the context of a stock that has bullishness built in the options prices. And again, all of this all together is telling you if it breaks from that line, that high, it may keep going. And again, if you needed this stock for hedging purposes, that's a valid entry because you also have the grouping in your favor. If you are planning to enter that stock and you don't have anything in your portfolio, so I would say don't do it, because that type of entry is never going to be as precise as waiting for price to come to a UFO and enter properly. But again, I need to give you two solutions for the ones that you cannot wait and for the ones that you can wait, depending on what else you have in your portfolio. Okay, so one option is to wait for this to happen. And so, in other words, price to go above this high, which again, this high is what? That high is 92.98. Current price is 92.28. Okay, so we are what? We are 70 cents away in a $90 stock. This could happen really in 20 minutes from now. We may be breaking this high. Okay, so you need to wait a little bit, but very, very little bit. Okay, now another possibility is that instead of having those little gray triangles, which are the pivot highs and the pivot lows, in this case, it's a long opportunity, so you only care about the pivot highs. The other possibility is to look at Elliott wave, which is this blue triangle, magenta triangle, purple triangle. They're also yellow. So if I look at my Elliott wave turning point tool, notice that we have 5 types of setups. It could be purple, blue, yellow, magenta, and orange. And the orange is long term, the light purple is short term, the yellow is short term. This one is ultra short term. Medium term is the blue, and dynamic, which is a way to say even shorter term than ultra short. So this one is purple. Okay, and again, you could have a trading plan where you're like, okay, I'm only going to trade the blue. Great. But in this case, I don't want to be perfectionist because we are looking for an excuse to enter a trade as soon as we can. And notice I said excuse. It's not like you are looking for an excuse just because. It's, again, you have the grouping in your favor. You have the climate in your favor. All that stuff. I'm repeating myself. You want to enter that trade for a hedge, and therefore any little thing that makes you enter at a price which is not a crazy price is good enough for you to take if you are in that situation. Okay, so that's why in this case I have activated all Elliott wave signals, as well as I got my high in case price breaks up. Okay, good. So now the one thing I have not discussed is what about the target? Okay, what about the target? So we're planning this trade using the 55-minute time frame, isn't it? Not this one. Okay, this one. Wait a minute. Yeah, this one. So the question is, if we wait for this market to come to this UFO and from there it starts going higher, so where is it going? Okay, where is it going? And the idea is to identify key turning points. Okay, key turning points that are very, very visual. You could actually go ahead and in your climate time frame or anywhere set up the same pivots I'm using on the 8-minute time frame. You could do that, but sometimes I guess it's not even needed. So if you look at this chart, I think we all agree that the key pivot is this one. So what I'm going to do is I'm just going to go ahead and project what a target could be from there. Okay, and the beauty of this projection tool for targets is that it does not depend on the time frame you use. It depends on the pivot that you select. Okay, and it's doing some sort of price calculations and looking at key ratios and so on and projecting where price is going, which is very convenient when you're running a portfolio made of multiple stocks, because again, just like I'm trying to be as precise as I can with my entries, but I cannot be that precise with stocks because stocks are fragile. They depend on the grouping, they depend on the S&P, they depend on on the competition companies, they depend on news. So stocks are way more fragile compared to other assets, right? So I cannot be that precise with my targets. So then having a price projection that gives you a wide area, it's in my mind more useful as you are running a portfolio where one of the targets is the very conservative one, the second one is the one I go for, and the next one is in case you want to be very 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 much perfectionist and really shooting for something very far away, which I wouldn't recommend unless you scale out or something like that. So notice that this little box here, which is the target, is pointing at 102, and therefore the opportunity on First Solar, okay, it's pointing at 102. Okay, that would be the target. So now the question is, now that I know, okay, that if that stock retraces to 86, 81, I want to buy it because all my rules are met, or if I need to enter it right now because I need it because I'm hedging. So I'm just waiting for an Elliott wave indication or a break of this line, and I can't just get it now. So you just need basically to kind of watch it, but that's going to happen. Any of the two is going to happen in few minutes. I mean, look at what happened yesterday, for example. So, let me move this down so you see it just a bit more. Here we go. So yesterday, actually that was not yesterday, this one here. So yesterday before the close, you would have broken that pivot high, but even if that pivot high was not there, at that time you got one Elliott wave indication, another Elliott wave indication. Today we already got one Elliott wave indication. The pivot high has not been broken yet, but my point is almost every day you got, let's say, 2-3 Elliott wave signals and potentially one or two breaks of a pivot high or a pivot low. So during the day you are almost guaranteed that you'll be able to enter. That's the point. And again, one more time, you do that when you need it for hedging purposes. Okay, so anyway, the target, okay, 102. Okay, so now that we know what is our timing for the trade, depending if you have a portfolio or you don't, and we also know the target, which is 102. So now the question is, okay, so what type of trade are we gonna do here? Okay, and this is now when we're gonna start getting a little bit more advanced with the spread select tool. Okay, the spread select tool, which is the tool that we are going to use to put together this trade and adjust all the Greeks. If you recall, when we do that with tradestation, you would see me coming here and look at the delta, look at the gamma. We had rules. I think I wrote that on the screen the other day. I'll write it again in case you have forgotten. The rules were when you do, for example, a bull call spread, so you need to sell a call higher and then you need to buy a call lower, isn't it? And the rule that we used to use, which we will continue using, it's buy a call between entry and target and sell the call beyond target. Those were the rules to pick the calls. Okay, those were the rules to pick the calls, and those were, and then from them we would pick the calls, and then we would move into OptionStation Pro and try to adjust the Greeks to be as efficient as possible. Then also we had another rule that had to do with earnings reports and expiration date. Okay, which we used to look at. Let me turn on strategy as well. Okay, so we used to look at FSLR, the option chain. So on TradeStation, so here's FSLR. So we used to look at the various expiration dates and the amount of price movement that could happen based on implied volatility, right here on the right. And if your target, it was going to be, like, for example, if you are taking the trade right now, right? So based on what I told you about the 8-minute time frame. So if you are taking the trade right now and the current price is 91.95, let's say that's the case, right? So 91.95, and your target is 102. So 91.95 minus 102 means that you are, oh, I just, okay, got it. 102 minus 91.95. Here we go. So that's $10.05. Okay. So what we do, okay, what you could do, and it's absolutely correct, is find an option expiration date that allows you to at least collect $10, which is this one, and that would be your minimum expiration date to accept the trade. Okay, that would be your minimum. But then we would look into the earning date. Okay, we would look into the earning date for that stock, and if that stock just reported earnings. So the next time earnings will take place is going to be on October 26th for First Solar. Okay. And there, October 26th, correct? And therefore, when looking at the option chain, so you will want to use that one, October 15 in this case, which is 72 days to go, which allows you to up to $16. You don't need 16, you only need 10. But we also like to align ourselves with the expiration date, so we suffer less of the theta thanks to a potential increase of Vega. Let me say that again. Potential increase in implied volatility, which would pay you through Vega. Okay, there is no increase of Vega. There is increase in implied volatility. So yeah. So again, how are we gonna do it with top? But we're gonna be a bit finer than that. Okay, because we're gonna use another tool called the strategy builder, where the moment you type 102, is gonna basically calculate what the target date is going to be, and the target date shows us September 9. This is the calculated target date. This, I believe I kind of explained it last week. It's not important now, so if you don't mind, I won't explain it. But it's kind of like looking into volatility, is looking at a regression line, is looking at a series of things, trying to predict when would you reach that target based on what that stock does when it comes to speed of movement, and so on. So that target date it's certainly very relevant. But again, even though that target date is 909, we just said that because of the earnings, we actually don't want to use that date. We actually want to use the expiration date that we would use would be October 15. Okay, so the rule for picking expiration will not change. We will just be able to be just a bit more precise with calculating the target date, which is 909. And I'm going to input that value here, target date 909, because I'm going to run a process with the spread select tool where I am going to calculate what happens if I reach my target on time, or what happens if I don't reach my target on time. Because if you don't reach your target on time, what's the issue? I mean, by the way, I've been talking like nonstop since we started. So what about you guys? Give me the answer. If you don't reach the target on time and you are using a debit option strategy, is that good or bad for you? Right? What happens as time passes to debit strategies? Okay, are you gonna get more profit, or are you gonna get a penalty? Right? If time keeps passing. So, what's the answer to that? Please give me an answer. I'll take a sip of water if you don't mind. Sorry for that. So, exactly, Siderman, very well. So it's bad, right? So again, it's good to have a calculated target which is very precise, so you minimize the problem of not being precise with the dates. But at the same time, even if you are very precise with the dates, the markets could be crazy any moment, so you may be totally off, right? And if you reach the target sooner, so then it's not a problem. But what if you reach the target later, right? So we're going to be able to simulate this in various ways to go a little beyond the things that we used to do when it comes to adjusting the Greeks, and look at various returns on investment and things like that, which are going to be very helpful for the life of the trade. Okay, so here we go. So I'm going to float this. I'm going to make it large, so we get to see all the columns. And the current price of that stock is 91.93. So again, let's pretend we are having, let me see, not yet. So let's pretend we're having an indication that is telling us go in now. Okay, so let's pretend that's the case. So what we will do is come in here. I selected October 15. I selected my 99 is my target date. I need to select the target price too, which is 102. Okay, and from there, I could click update and everything updates. But from there, basically what I'm getting, okay, it's whatever was here from the last time I used it. Okay, so right now I would like us to focus on a simple long call, which is a strategy that we all know. And even though we're going to do better than that, but let's go ahead and plan on a long call, and that's the only thing we're going to simulate in that first attempt. Okay. Now, which long call can I trade? Well, there are many, right? There are many available. So if I, load, sorry, an option chain, and I load October 15 expiration, and I load all the strikes for this one. Okay, so you can see we got strikes, we got many strikes all the way from 42 to all the way to 135. So I could buy, there are many calls I could trade. The question is, which one should I trade, right? And if you recall, we talked about something pretty interesting the other day when I showed you, let me graph this one. When I show you the risk graph, and we talked about using that ideal strike zone that basically plotted that box where we like the PNL line on expiration to go through the box, because that increases the probability of the option to expire for break even or better, and certainly that would help the trade. The problem of that is that then the trade becomes expensive. So the idea was to be somewhere along this box, especially if you are a little bit on the right on this lighter area. So then the trade becomes cheaper. Okay, but at the same time, it's not like it's going to be crazy low probability, because if you picked an option like, instead of 92, let's say I do 120, so now my box is going to be all the way here, and the crossover is happening here, meaning that for you to break even, the stock needs to be trading at 120 something, and the current price of the stock is 91. So in other words, it needs to move in your favor so much, which is very unlikely. And yeah, the good news is that you only pay 17 cents. That's why it's so cheap. It's a lottery ticket, right? So it's not a proper option. It's just a lottery ticket selection. It's not a a smart selection looking for quality as well as keeping the price as low as possible. So we saw that last week, and it was very powerful. But the idea is, how can I filter for it, right? So you can filter for it here. So I got my option spread filters, and there are many things. Let me uncheck everything. Let me uncheck everything. That's it. Okay, so it's all unchecked. Okay, so now the first thing I want to do, because I'm doing a call, so I'm just gonna activate some rules for my long legs. Okay, buying a call is a long leg, and here is the ideal strike zone. So I'm just gonna select that and say, you know what, I don't want it to be outside because this is low probability. I want it to be anywhere inside. Okay, so as long as it's in the box, I'll take it. So filter the various calls based on that criteria. And then when I click OK, and I go back to spread select, so in this case, you can see here on the right, option spread filter pass. Now, great. So that option passes. Okay, which by the way, by default, automatically spread select would give you options that pass for the strike zone, which saves you time. But the question is, there may be more that also pass, and there may be one that is cheaper. So let add more strikes and see what happens. And notice that as I add more calls, okay, now there are a few that pass, but there are some that don't. Okay, so now when you look at a few that pass, okay, and let me zoom in. So I'm freezing the screen now. So when you zoom in on the few that pass, okay, those 5 calls to be precise that pass, notice that the debit to be paid is either 1,000, 857, 7 something, and the cheapest one is for 92. Okay, now here you have the return on investment maximum, which is infinite, right? So if the stock goes to the infinite, you make infinite. The return on investment if you get to your target on the expiration date. Okay, and typically the more expensive the option, the more you will get paid. Okay, that's why it's more expensive. Okay, you got more delta, so you make more. But you also have the return on your investment based on the target date, And now notice that maybe the cheapest option is actually the one that performs the best, right? So again, now, what if you are off timing? Okay, so that's why it's important to be precise with the date timing, which is something that we've never done, right? To try to be as precise as we can with the timing for the date. Well, if you are precise with the timing for the dates, you can afford to get the cheapest trade and get the greater return. Okay, now what's the issue if time passes and you don't reach the target on time based on how you calculated? Well, then the $420 you were thinking to make become 207. So this is your P&L on the target date, and this is your P&L on the expiration. So if you didn't reach your target on time and now is expiration date, you still profit, but as time passed, you profit less. It's 420 becomes 207, 498 becomes 352, 573 becomes 477, etc. And again, this is great to know. And by the way, if you ask me which one would you take, that's it. It's clear. I would take the cheapest one because I am assuming I'm going to be more right than wrong with my plan, and therefore I want to have the least amount of risk. So I will go for this one. Okay, which that would be an option with, in this case, 44 delta, where if you put it on the chart is the 95 call, which is between entry and target. Okay, it's between entry and target, which is the rules that we always had. So I'm just giving you a bit more detail so you understand also why we had the rules that we had and why we're going to continue employing the rules, but add more stuff on top of it to make it even better. Now, the one thing I don't like, but I cannot change that. Okay, this, my friends, is the life of an options trader. The one thing I cannot change is the fact that if I don't reach my target on time, I will make less. That I cannot change it. Why? Because it's a long call. Now, what if instead of a long call, what if I do a bull call spread? What's going to happen? So let's uncheck long call and check bull call spread. And now notice I got plenty of trades that are pass, okay? And this is a bull call spread, and we'll look into the strikes later on, 85, 90, whatever. So I indeed need to talk about that. But for now, let's look at this, okay? So now you have some of the trades, for example, that one is 135, 120, 85 seems to be the cheapest one here, okay? And look at what happened. The P&L on your target date is 79, okay? Which is 93% return. Okay, why? Because you do a spread, so the cost is less, so the return is more. That's great, but not only that. Look at what happened now. If you reach your target later than expected, now you actually make more. Okay, now this is not gonna always be the case, and that is why many of those options fail. Okay, notice how the filter is giving you a fail for many of the cases, where some of the cases pass. Okay, so again, we're gonna be adjusting more parameters here. If I click on the settings wheel, we're gonna be adjusting more parameters like the delta. I read you, Joe, when you ask about the delta. I'm about to discuss that. So we're gonna adjust more parameters to make this as good as we can. Again, I'm gonna use the perfectionist approach, and then if I have to uncheck something, because you know how some options chain, they may only have strike price increments $5 at a time, where other options chain, they got like strike price increments every dollar, and you can be more precise with everything. Okay, well, sometimes you can, sometimes you cannot, and we cannot change that. So I'm gonna start from the perfectionist approach, and then I may have to uncheck something, but at the speed of the light, I'm gonna be able to build my trades and pick the best, okay, and get a comparison among the various choices without having to go and spend a lot of time looking at the option chain and right click and add and change strikes and look at my delta, look at my gamma. All of those things is going to be done at speed of the light here. Okay, so let's keep working on the long. Okay, so on the long, my only request, to be honest, here is going to be that the options that I buy are going to be in the ideal strike zone. That's my request. Now, for the ones that I sell, the opposite is true. I want them to be outside of the strike zone. Okay, I want them to be outside of the strike zone, because if they are not outside of the strike zone, they have a high chance of expiring in the money, and therefore that option with a high chance of expiring, yes, in the money. I say right. So then that option would have an effect which would hurt the P&L of the trade, because basically it would add too much negative gamma to the trade. So I'm gonna use the opposite rationale, because the reality is that buying and selling is the opposite of each other. So in this case, I'm using inside the zone. In this case, I'm going to use outside the strike zone. Okay. What else? Also, I'm going to select the minimum price for me to sell an option. We're going to make it 35. This is a rule that we always use with non-directional trades, but indeed, nothing wrong with using that rule to be directional too, because if not, you better end up just buying a call. That's it. What would you do the spread and pay more commissions if that option you sell only pays you, let's say, 10 cents? So let's make it a rule. 35 is the minimum. Okay. And then I'm just going to come here into the net spread exposure to Greeks. And for now, I'm just going to go with, I want delta to be between 25 to 45. Our rule, it's the closest as possible to 30 for the net spread, isn't it? So let's go between 25 to 45, because again, we need to give a little bit of tolerance, if you wish, to the filter, because as I said, not all options chain got so many strike prices, because some got like $10 strike price increments, right? So you may not be able to do 30. You may need to do 38, which is almost 40, right? So again, so 25 to 45 would be the request. And now if I click OK, and I go back to spread select, okay, I update, okay. So now again, I'm gonna have, in this case, all shows as fell, okay. And why is that? Well, because there is something I haven't explained yet. So let me go back here to 0, okay. So how many spreads you wanna build to see if they pass or fell? Well, in this case, I selected 0. Okay, and because I told the platform that my starting strike is the other money strike, the nearest strike, to 91.63, and I said I want to explore options above and below, right? So I can select above, below, or both. So in this case, I select both. So I want to see what happens if I buy options above or below 92.50. What happens if I sell options above or below 92.5? So let's see what happens. I indeed want to use both, and then, because of the strike price increments on the option chain, it seems that I could go as low as 240, and I could go as high as 91.20. So how large you want the spread to be? And the way you think about this is this. Let me come. I had it here. Yes. So if you look at the current price, 91.49, right, all the way to the target 102. Okay, this is kind of like how wide my profit zone is. And remember, I am going to be selling options beyond the target, okay, or somewhere around that area, and buying options between entry and target, correct? So in other words, I would say the minimum is that distance from 91 to 102. That's the minimum. But to be honest, it doesn't hurt to add a large number here. So the computer does the work, not us. So I'm just gonna pick, I don't know, 50, right? And when I do that, okay, by adding 0, so automatically the tool will build various option strategy where we can see already some of them pass, okay? And we can look into the Greeks, okay? We can see that, for example, this one got a net delta of 26, that one got a net delta of 33, that one 38, that one 42, that one 44. So we can see that the strike price increments actually are allowing us to be quite precise with the deltas, okay? So, you could go ahead and fine tune this a little bit, even though it's no need. So, the other thing you can do as well is to add a few more strikes, because notice what it's doing. Everything starts at 92.5. So you buy the 92.5, sell the 105. Buy the 92.5, sell the 110. Buy the 92.5, sell the 115. Buy the 92.5, sell the 120. And you are doing that all the way, okay, until you reach a range of up to 50-40 based on the strikes available. So you could also go ahead and maybe add 2 or 3 more strikes, okay? 2 or 3 more strikes, okay? And now what you're doing is that you are buying the 87, right? Then later on, you are doing the same using the 90. Then later on, you are doing the same using the 92.5 and then the 95 and then the 97.5. So basically it's kind of like you are building spreads all over the place, and then we're just going to filter out and only these pass. Okay, and this is now where, knowing that all of it is meeting your rules, so this is now when you can go ahead and get pickier. Okay, but we're gonna make this a bit easier for us because we got a bunch of trades that would pass our rule. So let's make this a bit better. So I want my gamma to be positive. Okay, we had that rule all the time. And I would like my rate of return when I reach the target to be at least, let's say, 50%. Okay, that's the minimum I want. So let me see what passes this. Okay, update. And we still got a great quantity of options trade that passed that. Okay, so great. So now let's add, what about my gamma at target is also positive. Okay, okay. And when I do that, so now I got only a few, not so many more. And this is exactly what I wanted. So now I can take these trades. These are all the various combinations that meet our rules. Okay, and now if we look into performance, okay, so rate of return, return on investment at the target, 99. Okay, 99. And notice that in this case, we are having a drop from 99 to 57, 100 to 64, 100 to 79, 94 to 73, 95 to 79. And the one that stays almost the same is this one, 97 to 91 is almost the same. So it's kind of like time almost does not hurt you. Sometimes, not always, it depends on the strike availables and so on. Sometimes we will find strike price increments and option chains that allow for improvement. So if you get to your target late, actually you make more. But in this case, it's pretty clear that the best choice is actually the one on top, where basically time passing doesn't matter as long as you reach the target before expiration, of course, because if not, the option expire. Then you would make more or less the same amount of money, if you reach the target on time, or if you reach the target late. So if you reach on time, you're gonna make 483. If you reach late, you're gonna make 454. Okay, that's the performance of this trade. And if you're curious to find out more about the Greeks, so in this case, it's a 38 Greek, 38 delta option trade with positive gamma, what you would have in your hands with a very contained vega as well. So volatility will not play a very big role. So the trade would be made of buying the 92.5 and the 115 strike. So this is the trade that we would take, and you would now be ready to populate a trade ticket and execute this trade. Okay, that's what you'd be ready to do now. Okay, just take a trade. Now, of course, not immediately. You need to make sure that you've been given permission to do it. So far, we haven't got that Elliott wave turning point. We haven't got a new pivot point that is being broken. So we still need to play patience, but we know that 92.5 and 115 is the trade to be taken. Okay, is the trade to be taken. So the question is, did I drive you crazy? Because of course, when you look at this, you're gonna be like, that's a lot of data. Okay, well, it's gonna be very simple, guys, because now I'm gonna take this, okay, and let's say this is my favorite set of conditions. So now I'm gonna save it, okay, and I'm going to say this is my directional long parameters. Okay, ooh, look at that, we're about to have an Elliott wave. Maybe we have it now. So directional long parameters. And when I do that and I click OK, so now what happens is I go back to spread select, and here it says your settings are directional long parameters. So in other words, you will basically, and by the way, I will prepare that and I will send it to you guys so you don't have to prepare it. But basically, you would have, your preferred rules in here. And then let's say now you are doing an Aron Condor. So we just go ahead and load the template. And instead of picking directional long parameters, you would pick Aron Condor parameters, whatever. And then, just add those spreads, and then the filter will do the job of approving or discarding the trades for you. at the speed of the light. Okay, not only at the speed of the light. Okay, here we go. We got the Elliott wave. By the way, that's exactly what needs to happen. We got the Elliott wave, and this candle it's trading above the prior high, not the pivot high, the prior candle than the Elliott wave orange line. Okay, so it's time to enter. It's time to enter, and therefore, you know what? Let's conclude the session by doing it. I'm just gonna enter this trade. FSLR, sorry, trade FSLR. Thank you so much, Maka. Thank you so much. It's very complex, but with the use of the tools and the templates and everything, it's going to be so simple and so time saver. And most importantly, as a trader, on top of that, it's going to be putting us in an even more advantageous position that what we already do, which is not bad. So we said the right trade to be taken is buy the 92.5 and sell the 115 using October 15 expiration. So buy the 92.5 and sell the 115 using October 15 expiration. Here we go. Okay, I'm just gonna, as you know, I'm gonna use market just so I get executed right now because it's time to stop the session. It's time to say bye. So I'm just gonna go with market. Please, please, please don't do market yourself. If you're gonna take this trade, don't do market. Okay, the system is missing quotes, so there is a problem there with a demo account with TOS. You know what? I will try one more time. I'll do a limit order this time to see if it takes it. And if not, then it's not. But at least today, at least you got to see the process. Okay, so the order is in. I'll be watching this and let's see if I get filled. Okay, guys. Before we go, can I have a final word from you guys? How did it go? Did I indeed drive you crazy? Are you happy to see what you see? Again, good and bad, guys. Share with me because obviously there is a lot of the things that we are developing here that has a lot to do with helping you and making your life easier, as a trader. So your feedback is indeed, needed. But also, I will say that we indeed also need to spend a bit more time together and using the tools a few times so it becomes second nature. Okay. Nice. Which is the delta? Yeah, the delta is right here. So you have delta for the option you buy, delta for the option you sell, and then finally you have the total delta for the position. Is right there. Maka, thank you. Joanne, it was fun. Great. Thank you so much, Wayne. Thank you so much, Mario. Thank you so much, Clive. This is really, really good. Thank you so much, Sederman. Very, very happy to hear your comments, guys. Very, very happy. We're getting close to the launch day, guys. We are fine tuning. You know how software development is. I really thought we'd have everything ready, at the end of last week, and it's not the case. So we may need another week, or something like that. But we are really, really, really close to have everything in the right place for you guys to be able to start using it. So we are getting very, very close. My friends, a pleasure to spend time with you as always. I will see you tomorrow, same place, same time. Let's keep going. More stuff tomorrow and more trades. Little by little, we're getting faster now. So I'm excited. See you tomorrow. You got filled at 495. Nice to see. Thank you, Joe. Thank you, Joe. I try. Indeed, I put all my experience. That's for sure, and also my heart in it. Indeed. But anyway, really looking forward to have it in your hands. So you guys can also come back to me and not only share how cool it is when you see it, but also when you use it. Okay. So working hard to do that soon. Take care, everybody. Bye bye.